Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and I am very excited to have a new educator joining us on the OptionsPlay team, Jessica Inskip. This is a really exciting time for OptionsPlay members and OptionsPlay team to have Jessica join us recently. But she's going to be helping me and embark on a new journey for OptionsPlay members to help you better understand how to trade options and utilize the tools that you have available to you to navigate the market. So with that, I want to first say a big welcome to Jessica, and I hope everyone here please jump in and welcome Jessica to the team. Jessica, thank you so much for joining us this afternoon.
Yeah, thank you, Tony. I'm excited to be here.
So today what we are going to do is talk a little bit about options pricing. But before we do that, I do want to talk a little bit about Jessica, her background, to give you guys a better understanding as to what you can also expect from Jess and I over the next few months with respect to options education, making sure that you have access to the right tools here at OptionsPlay. So again, like I said, very, very excited to have Jessica join us on the team, and we'll talk a little bit about her role and what you can expect from Jess and I over the next few months. So Jess, I'll give you a couple of minutes to talk a little bit about your background and where you came from and how you came to joining the OptionsPlay team. But just to give everyone else a little bit of background, Jess and I have actually worked with each other for quite some time over the past few years, working on different initiatives with technology with respect to the OptionsPlay platform, as well as education. So her and I have worked together. We've actually produced quite a bit of options education in the past. So really excited to have her join the team, and you'll see some of her work here today. And I think you'll be impressed with the options education that she'll be producing.
Yeah,
so Jess, if you don't mind, just a little background as far as kind of where you came from and how you joined OptionsPlay as a team.
Sure, yeah. And I'm really excited to join the team. So thank you for that. And yes, we have known each other for quite some time and collaborated on trading strategies and lots of initiatives. So definitely happy to be here and glad that I landed here. I have worked at a couple of different firms, and I got into really the stock market because I thought I was being clever. I was actually got an internship in college at a place called Scottrade that no longer exists. But at Scottrade, they had a paid internship, and I learned that I could get a college credit and get paid at the same time. And I fell in love with the stock market simply by being clever, I suppose. Nonetheless, I really started diving into options and technical analysis. I originally wanted to be an architectural engineer, so I had a really big mathematical background, and I found that I could have that within the stock market. And then, of course, that naturally gravitated towards options and technical analysis, and here I am.
Well, I mean, I think a lot of our viewers will probably relate to that background. I think we have quite a few viewers and members who are engineers. I think that's probably the predominant profession of who ends up many times using technical analysis and options trading. Not to say that most of you that are watching that aren't engineers aren't here in the right place, but I think a lot of people can relate to that kind of background and why it lends itself well to, looking at the markets from this particular lens of technical analysis and options trading. So Jessica, I'd like to ask you a little bit about kind of why, specifically technical analysis for you. You and I have spoken quite a bit over the years as to how important technical analysis is to your work of understanding the markets. Why don't we talk a little bit about just kind of what is it about technical analysis that you found interesting, and why you ended up spending so much time using technical analysis to help you navigate the markets?
Yeah. So I like patterns and studying those, and I think that goes back to mathematics, and also options, I guess, would be related with the same. Everything is really logical, and you can formulate patterns and look for consistencies and then make decisions based off of that. And I like that predictability and having that type of control, I suppose.
I think a lot of people can probably relate to that, and especially when you think about kind of just how uncertain the markets are, having that predictability, having that objectivity, in my opinion, that that technical analysis provides, and I think that that's a different lens, and I'm hoping that we can dive into that with some of the sessions that you and I will be hosting together, is really just how to utilize technical analysis in a way to provide an objective view on the markets. A lot of people tend to find that charts are very subjective. You can draw all these different lines, different indicators, and have different views. But I really think that if technical analysis is leveraged in the right way, does the exact opposite. There's very little subjectivity in it. It's very clear cut and bone dry as to whether the charts tell you one or another. So those are some of the things that I hope to be able to dive in with you on technical analysis. But on the options trading side, this is really what we're here to talk about here today: options pricing. I'd love to hear a little bit about kind of how you got into options trading, after learning about technical analysis. And many of you watching here today might know my story about how I learned to trade from Tom Sosnoff on the Thinkorswim platform 16 years ago, watching his webinars as an entry-level kid on Wall Street, trying to just figure out what to trade, and him being one of the few people back then talking about options, doing education on a daily basis and a weekly basis, and learning how to trade from him. Love to hear a little bit about your background as to kind of how you got into options trading.
Yeah, I definitely learned a lot from Tom myself as well, as you know, but nonetheless. So options was born around the same time as technical analysis, to be honest. That was also back at Scott Trade. So fast forward from my internship, I was there about 2 years, and I decided to become licensed. And at that point, I thought I would be a financial advisor because that seemed like the only path. But there was always, when people would come in, they would talk to this one specific individual because he knew options. And I realized that I needed some form of notoriety, if you will. And so I did it purely just so I can seem smart. And I was a young female. Like to think I'm still young now, and at that time, therefore it helped me have that wow factor so I could have those conversations. And just like with my internship, that it really navigated my path, and I really fell in love with options. It's something I do on my spare time is read SEC reports and dive into a lot of data. And so it's something I've really turned into loving.
Yeah, and I can just say, working with you over the past 5 or 6 years, your passion for both technical analysis and options is extremely clear, and really part of the reason why, I'm very excited to bring you onto our team. And I'm sure for those of you that are viewing this today, you're going to see her passion for both technical analysis, options, and just the general markets will shine through. And I think this is a good time for us to segue into what viewers can expect from you joining us as our newest director of education over the coming months, and kind of how we're structuring or restructuring our education to fit that. So Jess, if you don't mind walking us through, what we're learning today, what track that falls under, and kind of what we expect to build in going forward.
Yeah, so we created an options course track really designed to build on the foundational concepts that get you. It's more of a different way to build along the way. So we categorize it into 3 separate things: essential, seasoned, and master. Today, we're on the essential track. So literally looking at options pricing and understanding calls and puts. The way that I like to teach this and talk about it is actually little tricks I've learned along the way from other people. I've had really great opportunities throughout my career, and I want to make sure that I bring that to this group and this special group of people. But also that these first 2 webinars really build on the Greeks and advanced concepts. And there are ways to put that together where everything just really is crystal clear and everything's designed to give you those light bulb moments. So I'm really excited to share that with you and curate it along the way. But there's foundational concepts. The way we get it all the way through is we'll start with single-legged options and get you all the way to condors. But not only just knowing what it is, actually understanding it is the goal of it.
Yeah, and I think that aligns really well with kind of the DNA of what OptionsPlay and what I've been trying to build effectively on my own over the past few years with education. So I'm really glad to have someone that shares the same passion and same process for teaching here at OptionsPlay. And I know many of you that have been with us for a long time can appreciate that. And I'm really looking forward to having someone else on the team to take the reins with me on this front. So with that, I think this is a good time for me to hand over the session here to Jessica to walk you through options pricing. Again, this is one of the essential foundations of options trading. I cannot express to you how important understanding the foundations are in order for you to start trading some of the more advanced strategies or even start trading the basic strategies. So regardless of whether you're brand new, if you've been experienced as an options trader, we actually have a quick poll that we just want to ask the audience here, just to ask, how often do you currently trade options? Whether you're brand new, if you trade quite frequently, quite infrequently, if you don't mind answering this question. This gives us an understanding as to who is attending the session. We'll try to tailor the session a bit to the audience, but it looks like there's a small percentage of you that are brand new to options trading. So for those of you, the 13-14% of you that are brand new to options trading, welcome. This is the foundational series that you need to learn in order to start advancing and trading options in your portfolio. But most of you here, probably about 85% of you, have currently traded options. And I cannot express to you, from my experience working with traders over the past 15, 16 years, how important the foundations really are to understanding option strategies. So hopefully you'll learn something new here today from this session, even if you're currently trading. I tend to find that most even seasoned and experienced investors still pick up something from these sessions. So hopefully this helps you build a solid foundation that the rest of your options trading can rely on. With that, like I said, I'm going to hand this over to Jessica and let her start the session. Thank you so much.
Yeah, absolutely. Thank you, Jenny. All right, so as always, have to start with a disclaimer. Where I came from, we have a lot of those, so we're going to bring it down. Types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investing planning advice. All examples are for illustration purposes only, and examples do not include any commissions or fees. So what are we going to cover today? Let's look at the agenda. We'll start with the anatomy of an option. So the components of an option, the real basics you may be familiar with, but just breaking them down and giving you a quick reminder. We'll dive into calls versus puts, give you a little chart that I've always used to really differentiate everything. We'll go into the options premium, which is the core of what this agenda is today, how the option is actually priced. The components of intrinsic and extrinsic value. There will be lots of examples along the way. And of course, we'll save Q&A through the end as well. All right, so let's start with the anatomy of an option. So an option is essentially a contract between a buyer and a seller. And with any contract, you ask these questions. So what quantity are we agreeing on? What's the product within this contract? What price and what time frame? That is depicted as the contract amount. So the quantity is the contract amount. It's generally one contract will represent 100 shares. The product is the underlying security. That can be a stock, an exchange traded product, fund, note, index, currency, or commodity. The price that we're agreeing on is considered the strike price, and that's priced at a per share basis. So if one contract represents 100 shares, the strike price may be $100. It's just represent per share altogether. The time frame is simply the expiration date. That's normally on Fridays. They're issued originally quarterly, monthly, weekly, and then there are some throughout. And then an example of that, and we're going to use ABC throughout, is one ABC 100 April 14th, 30 DTE. So I'm using something throughout that has 30 days until expiration. You'll see DTE a lot. That just means days until expiration. So this literally means that we have a contract that represents 100 shares of ABC stock at $100 per share. And that contract is in existence until April 14th, which is 30 days from now. The contract is then issued as a call or a put, and that determines if it contains the right to buy or the right to sell. So if this example were a call, it would contain the right to buy 100 shares of ABC at $100 per share, which means I could literally exercise my rights and say, I want to buy 100 shares of ABC at any time if I hold that option. That's what it represents, is buying 100 shares. The put is just the opposite. It's the right to sell. So if this contract were a put, the person who holds this contract would be able to say, hey, I want to sell ABC at $100 per share at any time up until the expiration date. When the contracts are issued, they can be exercised. So that's literally executing upon the terms of the contract. So again, if the call holder has the right to buy 100 shares of ABC at $100 per share at any time, they could say, I want to exercise those contracts, in which case they would literally take ownership of the shares and have those 100 shares of ABC stock. The put holder would do the opposite. They can expire. So unlike stock, they have a finite life. A option has an expiration date attached to it, and that has a lot to do with the pricing component, which we'll definitely dive deeper into. But there is an expiration included with it. And they can also be traded on an exchange if a market exists. And the price in which it's determined it can be traded at is issued at a premium, which is where we're the heart of this presentation, and we'll talk about the premium components and what it's made up of. So before we go into the pricing, I'm going to introduce you to this T chart. You've probably seen it before. It's something when everyone gets their Series 7, they teach you this. If you used to walk around trading floors, this was all over walls, and something that helps you really understand the differences of calls and puts. So it's a simple T chart. You've got calls on the left and puts on the right. We'll start with the buyer on the top quadrant and a person who buys a call is considered long that call. And then the seller on the bottom, the buyer of the long put here, and the seller of the short put here. So anything that is a long option is something that's purchased, and that's purchased for a premium. This is a really great tool to use because if you focus solely on long calls, you'll notice that everything is a mirror. So if you just really know a long call really well, you can figure everything else out with the use of this chart. And that's what's really important and valuable about this chart. The top quadrants, or excuse me, the bottom quadrants here are all bearish positions, and then the top are bullish. Won't go into too much details of the difference of calls and puts. That's actually the webinar that we're putting together next week. But the purpose of this webinar, I really want to focus on long calls that you have the right to purchase securities when you hold that long call. It's just for a premium. You're the driver in that situation. You can exercise on the terms of the contract at any time, but we're going to focus solely on long calls right now. All right, so into it, how is an option priced? The options price is called basic components, which is intrinsic value and extrinsic value. Intrinsic value is in the money value or actual option value that it contains. If that ABC example, so if I have the right to buy at 100, that's what the contract contains, and I hold a call, and ABC is trading at 110, well, if I can execute the terms of that contract, buy 100 shares of ABC at $100 per share, and then immediately sell it at the market at 110, then that has to be worth at least $10 per share. So that's the in the money value or the actual value that the option is worth. And we'll dive deeper into that with some examples as well. With the extrinsic value components, there are two pieces for that. The first is time value, and that makes sense. So the more time a contract has to move above or below its strike or have in the money value or intrinsic value, the more expensive it's going to be. And that's logical because the more it's an option that is 45 days from now is going to be more expensive than an option that expires 30 days from now. The longer dated it is, the more expensive it's going to be because you have a higher probability of success. It's really what it comes down to. And then the other major component of extrinsic value is implied volatility. I'm not going to dive too deep into that today, and we'll have separate sessions on that. But implied volatility, the textbook definition is the market's forecast of a likely movement of the underlying security. A really great example of that is earnings. So when earnings comes around, we expect an anticipated market movement up or down in either direction. Not sure which way, just depends on how you feel about the security. Nonetheless, it's a large movement that's expected, or an anticipated swing. Therefore, the option will be more expensive because it's expected to move more. So you can see how all of it is logical. Does it actually have value? How much time is left for it to have that value? And is there any surrounding events that's going to make the likelihood of that value higher? And that all equates to the components of the options premium. A good way I like to remember that is intrinsic value is internal factors that affect the options premium, and extrinsic is purely external. And there is a question that I used to get a lot is, why is my option not moving in tandem with the security? And a lot of that has to do with the external factors that are affecting the options premium. It's not purely the underlying security that determines the actual value of the options premium. So let's build on that example. So using ABC stock, and right now it's at $103 per share. And we're going to use that same ABC $100 strike price, 30 days till expiration call. And we'll say that's trading at $5 per share. So remember, this is a call, so it represents the right to buy 100 shares of ABC at $100 per share at any time within the next 30 days. The premium, intrinsic value plus extrinsic value. So if it has the right to buy 100, and I can have ABC at 103, so I can go ahead and sell at the market at 103, it has to be worth at least $3. Extrinsic value is really just the excess component. So if the premium's 5, the money value or intrinsic value is $3, the difference of those two is 2. So that's literally as simple as it is. Intrinsic value can be 0. There could be no value within the option. The option could contain the right to buy at a higher price than the market. Therefore, it wouldn't make any sense for you to exercise that. Therefore, the option wouldn't have any intrinsic value. However, it should have some type of extrinsic value. Either could be 0, and we'll talk about that with a little more examples. All right, so ABC stock again, this time it's up $2. We're at $105 per share. And we'll go through a couple of different prices. So we'll look at a $95 30 days till expiration call, the last price of 12. So remember, this contains the right to buy 100 shares at $95 per share. So therefore, the intrinsic value has to be $10. And then the extrinsic is going to be the excess $2. We have a same 30 days expiration, but we look at a strike price of 100. I have the right to buy at 100. I could sell at the market at 105. Therefore, it should be worth at least 5. The premium is 8. Therefore, the extrinsic value is 3, the difference. Same expiration, but we're going up another $5. This time the premium is 5. This is actually an at the money option. So we looked at in the money options here. In the money just means it has some type of value. Since 105 is equivalent to the market price, it's considered at the money. And at the money option, it doesn't make sense for you to exercise your option to get the shares. You could just do the same thing at the market. Therefore, it doesn't have any intrinsic value whatsoever. It's not more favorable. It only has extrinsic value of $5. We go up another $3. This is a contract where we have the right to buy at 108. This is considered out of the money. This has 0 intrinsic value, and again, full extrinsic value. So any option that has value where the strike price is more favorable than the market. So for a call, if it's lower than the strike, you could buy at a lower price, then therefore that's in the money. If it's the same price or even near it, we consider that at the money. And then if it's higher than the strike for a call, then it's considered out of the money. Now, something you might have noticed here, and what I did do is I actually used Apple for this example, and I normalized it to get it to 100. That way there's some real actual values here to have some good lessons. And the one here is extrinsic value actually isn't linear. And you notice it's higher right here. So all of these options have the same expiration. They all expire within 30 days. However, remember that likelihood I was saying before, the time value component or extrinsic value is actually centered around at the money. And think about probabilities. If you have something at 105, the likelihood of it going in the money or out of the money it's a 50%, right? So there's a higher chance that it's going to move above or below your strike right when it's at the money. Therefore, the extrinsic value is actually centered there, and you'll see a little spike there, and that all goes into likelihood, and that's that logic that I love about options. And I will give you some real life examples. So this is something I really like about OptionsPlay's platform. When I was at my previous firm, I actually would pull it up and do training sessions internally with it. And it's really great, even when I was working with clients, to explain how options really work. And I'm going to do that with you today. So right now I've got 3 strategies going into what all of these have 30 days until expiration. One is in the money, one is at the money, one is out of the money. And you can see here, I've got my screen covering, there we go. The in the money option has $7.73 worth of intrinsic value and $3.27 of extrinsic value. So that's the total trade cost is 1,100 divided by 111 per share. That's where this is coming from. The at the money has the highest extrinsic value of $4.50. So this entire premium is made up of at the money, and the out of the money has the lowest. And so that's just a real life example. Took the screenshot yesterday of Apple, just showing how that extrinsic value is centered on the at the money options. Let's go into another example and look more into extrinsic value. So now I'm going to change the expirations around. ABC's sideways at 105. So we're going to look at a 100 strike price with 0 days until expiration with the last price of 5. So essentially this has all intrinsic value because I have the right to buy at 100. I can immediately sell at 105. The option has to be worth at least $5 because of what it contains. However, there are 0 days left until expiration. So time value is completely depleted. There is nothing there on the day of expiration. Options are normally worth only their intrinsic value. And that's an important piece that we'll talk a little bit more about. Let's look at the same strike, but now 30 days out. This one's trading at 8, same intrinsic value of 5, difference is 3, which is our extrinsic value component. Let's go out another 15 days and look at 45 days until expiration. Same intrinsic value. This time we have extrinsic value of 4. I'm going to kick it out to 60 days until expiration. This is trading at $9.50, same intrinsic value because our strike price hasn't changed, and the extrinsic value is $4.50. So now here's something else that has happened, and then I hope you noticed, is all of these options have the same strike price, therefore they have the same intrinsic value. And you may have made an observation that time value also isn't linear. And that's something that we'll dive a lot deeper into later, but it's important to know from the pricing mechanics of options is time does work against you. And it's always that depleting piece of the options premium, but it depletes slower at the beginning of the option's life. And then it's like a cliff as you get towards the end and towards expiration. And that's what you see here. It's not equal throughout, and it depletes very quickly the closer it comes to expiration. And let's prove that again with the OptionsPlay platform. So I did the same thing here. This time I have a 2 days till expiration because, again, I took the screenshot yesterday, so it didn't give you a 0 DTE, but nonetheless still proves the point with the same 150 Apple call with 2 days, 30 days, and 45 days. All of them have the same intrinsic value, have the right to buy at 150, can sell at 158. But the 2DTE has 20 cents left of extrinsic value. So not too much, and that's because it's at the end of its expiration. Go 30 days out, you've got 295. Another 15 days, you got 470. So this 30 days isn't doubled this price, if you're to do the math there. And that just shows how time really decays when you are purchasing an option or when you have an option period within the pricing. And that's an important factor of options, and a lesson I think a lot of people learn the hard way when you first start trading options, is that time value component, and not really accounting for extrinsic value and how it reacts with all of its various components, which is time and implied volatility, which is what I really want you to gain from today. So let's go ahead and build on that example and go through a chart of other events. So let's hypothetically say that we placed a trade and purchased a call when ABC is at 105 per share. We have the same strike price of 100, which means we need it to go above $100 per share in order to be profitable. And we've got a 30-day expiration. So in order to do that, we would buy to open. So that's our opening transaction for the option. One ABC 130 days till expiration call at $6 per share. So we've got 30 days to have this option be worth something, and we purchased it for $6 per share, total of 600. That means $5 of this is worth intrinsic value, and the difference is extrinsic value, that $1. So let's say some time has passed, it's expiration day, and ABC is at 110. The option value is going to be $10 because on expiration now, there is no time value. So we'd expect that to completely deplete. Therefore, this is gone, it's gone up in value. And therefore we've made $4 per share, or 400 total. So this is a good situation for a long call holder. I am bullish. I want the option to go up. It went up above my strike. We made money. So let's look at a different example. Let's say it didn't go above our strike, and now we hit expiration and ABC is at 105. Well, the option is worth $5 at this point, because remember, if we can buy at 100, immediately sell at 105, where the market is, it's worth $5 of intrinsic value. But now the option has lost all of its extrinsic value. So that's the time value component that's completely depleted, that we're unable to recapture. Therefore, we actually have a loss of $1 per share, because that time that we purchased has escaped from us. And it's something that a lot of these examples we're going through are talking about options held until expiration. And that's actually quite unlikely. Most options traders don't hold options till expiration, and it's something to be cognizant of. And that's because of that time value component. When you buy something, you are also buying time, and it's important to have an exit strategy in mind. That way you can capture some of that time value purchased. So let's look at a different example. So let's say, worst case scenario, we were extremely wrong on our sentiment and ABC goes down to $95 per share. Well, now our option is worth absolutely nothing, and it will expire worthless and just be removed from our account, in which case we will experience maximum loss of $6 per share, or $600 total. So therefore, time has completely gone. You held out for hope that your option would go up in value or down in value if you had a put, and you lost everything completely. So what I wanted you to gather from that is the concept of time and extrinsic value. And back to that question, really where this whole webinar was formulated around, is that common question received of why isn't my option moving with the stock? And that is simply time. Sometimes you need the stock, like in the previous example, to move more than it already has, simply because you have a depleting component of your options involved. All right. So that reached the end of our segment. I feel like I really flew through that, but does anyone have any questions?
And for those of you that have questions, please submit them into the Q&A section of the platform. So at the bottom of your chat window, at the bottom of your screen, you have both a chat window and a Q&A window. If you don't mind, please type your questions into the Q&A window and we will answer your questions out of that section. For the questions regarding this, whether or not you'll get the slides and the recording, as always, we will send you the slides and the recording after we finish here today. And we do have a quick poll here, just to make sure that you've learned, you can test what you've learned here today. Especially for those of you that are brand new, you want to make sure that you understand today's content. If stock XYZ is currently trading at $52 and a $50 call option is currently priced at $4, what is the intrinsic value of the option? So just to help you test your knowledge of what you've learned here today.
Got a really great pass rate so far.
So far, we have a 98% pass rate on this question, 99%. So it does seem like most of you are understanding the concept of intrinsic versus extrinsic value. Now with over about 60% of you have participated in this particular poll, we will end it. Looks like 96% of you did get the answer correct, which is $2. Okay, let's look at some questions. Would it be wise to sell an at-the-money cover call or cash secured put to capture the highest extrinsic value? I think that's a really good question. I think from today's session, that's one of the a really important lesson to learn from this. And I think that if you are looking to maximize income, yes, what you've learned is that selling the at-the-money call or put will generate the most income. But you also have to understand what the trade-offs of those elevated income levels are. And Jess, if you want to walk through that real quick, it's all about trade-off. Yes, you will get the most income, but there are some trade-offs.
Yeah, absolutely. And if you have a covered call, that one really comes to mind. The way I utilize covered calls is really for your exit strategy. So if you're giving up upward movement. So yes, at the money, you're going to get a lot of extrinsic value. And if it's shorter term, that's going to decay really quickly. But if it's shorter term, there's not going to be a lot there. So you're going to give up upward momentum. So it's a trade-off for where you want to sell your underlying security at versus capturing that value. And there is another question that really links to that, which is picking strikes based on deltas or support and resistance lines. And that's where the Greeks are really helpful. And we'll go into that in later sessions, but you can utilize both of those things to pick your strikes. I use delta and gamma to pick my strikes actually, and a lot of support and resistance lines. Yes, they're very helpful.
And there's another question here that's related to that. Can you talk about options price movement versus stock movement? That's something that we'll talk about in the Greeks session, but it is all interconnected to what we're talking about here.
Yeah, and that's really intrinsic value as well. So I guess from the core basics of it outside of the Greeks, if you've got, like I said, that $100 strike and the stock goes up from 105 to 106, it should be worth at least from $5 to $6, but it's not going to be worth exactly $5 at that time and exactly $6 at that time. So it may be $5.60 to $6.10. So it's not dollar for dollar with the stock, but we'll go deeper into it with the Greeks. It does move and it should always have that intrinsic value, the actual value of the option. But as far as when it moves, there's a lot of other components that go with it. Yes.
Yeah, and Winston's asking a great question, which is what is the math behind to get to extrinsic value? And there's two ways that I think you can look at this. Yes, you can potentially plug in mathematical, inputs into a mathematical formula to get what is an assumed extrinsic value based on volatility, and volatility is really the only component that's unknown, and you can make assumptions as to what you think the future volatility of the stock will be, and that will help you back into what the extrinsic value of an option is. But the other school of thought is the market tells you what the extrinsic value is, and that's what implied volatility is. Implied volatility is what is the market insisting or implying what the future volatility of the stock is going to be, because what you get from the market is the current price of an option. What is the bid-ask quote of the option? What is the last traded price of an option? That tells you what the market anticipates, what the extrinsic value of the option is, and that it allows you to back from that same formula what the expected future volatility is going to be. So there's really two ways to look at it. Either you think that you have a view that's different from the market and you can plug that in and get an extrinsic value, or you can take the extrinsic value from the market and see what the future expected volatility is, which is what we call implied volatility. Jess, there's a question on this is a good question, and I'm curious to hear your thoughts on it. But there's a lot of questions around, if I sell a weekly option 4 times, 1 week at a time, but doing it 4 times in a row versus selling a single monthly option, kind of what's your view on that? And generally speaking, where do you get the most income?
I definitely would want to look at the Greeks for that, for sure. But it really depends on what you're doing in the underlying security as well. So if it's something with a really high beta or something that's really volatile and I'm just going to capture income, I don't want to give upward potential, then I would look at weeklies for something like that. But if it's something less volatile, that I'm a little more long-term on, a lower beta, then I would probably go monthlies at that point.
Yeah. So I would say that, there's the theoretical answer and there's a practical answer. The theoretical answer is that, yes, if you sell 4 weekly options in a row, you're theoretically going to generate more income from that than selling a single monthly option, assuming that you apply the same deltas to all the strategies. But from a practical perspective, when you sell 4 weekly options, the chances that all 4 are going to expire worthless and you're going to be able to add up all of that income together to compare that to the 1 month option, not as likely. Chances are sometime throughout that 4 weeks, one of them may get assigned to you and you're not going to collect the income for the 3rd or 4th week because you got assigned on the 2nd week, right? So that's a practical thing that you have to consider, that you may not end up with the same amount of income because you can't assume that all 4 weeks you're going to actually collect the full income. The second thing is also transaction costs. How much are you paying in terms of fees and commissions, and how much are you paying to the bid-ask quote that you're going to potentially have to buy and sell if, let's say, you have to close out that trade before expiration, and you have to factor those things in. I generally find that once you factor into fees and commissions, transaction costs, and all of those things in all together, chances are the difference between a 4-week option, even if you're able to do it 4 weeks in a row and collect the income, versus the 1 month option, the difference between the two end up being fairly negligible, sometimes even worse than selling that monthly option. So hopefully that answers your question, Daniel. It's the theoretical versus practical. You always, from my perspective, have to think through the practical part as well, even though the theoretical part makes more sense to do one over the other. And maybe Jess can answer this. Do you offer webinars on option strategies such as spreads?
Oh, we're about to. Yes. We've got, if you missed the previous slide, and I'm sure this will be sent out, we've got a whole course lined up that's going to cover absolutely everything. So we'll go deep into spreads. We'll even have specific ones. I think we've got one scheduled for bull call spreads as well coming up really soon. But we want to introduce it in a manner where it builds on itself. So when I talk about spreads, I definitely like to go into the Greeks. And so I want to make sure we have an introductory on the Greeks before we do that. That way, those questions that we're getting on how do I pick my strike prices, all of that's around the Greeks and technical analysis. And we'll make sure you're introduced to it a way that you can fully understand it and digest it. So I think that's great. Yes.
Yeah. And Jess, maybe if while I answer the next question, you can bring up that slide of the upcoming events, because I've hosted a lot of different webinars on different topics, including just about every single spread you can imagine under the sun. But Jessica has a whole educational track between beginner, intermediate, and advanced that we're going to be going through to help you better understand the foundations like we're doing today, but also those advanced strategies such as spreads. There's a question here asking about options volume and open interest, and how does that reflect your choice in selecting an expiration date and strike price? Jess, I'd love to hear your views on that.
Well, you definitely want something that has liquidity. That's really important. And this is one of the things I actually really love about OptionsPlay is the liquidity ranking that is built within the system. So it'll actually do that for you. However, it's important with pricing. So we could talk about pricing as and understanding it in details and the Greeks and everything. But if there is no way for you to actually execute upon that, so no one wants to sell or buy on the other end, then there's no reason to really be trading that. So it's important to have liquidity, which is volume and open interest. Otherwise, it may be a difficult situation for you.
Yeah. Let's take a look. Some more questions. Melanie's got a good question about stock and around earnings, and I think that is usually due to the extrinsic part. And I think we could talk a little bit about just briefly. And you did touch up on this in terms of external factors like earnings. That does have a fairly sometimes sizable influence on the extrinsic value of an option, especially as you get closer and closer to expiration. Melanie asked, the stock did well on earnings, but it lost rather than went up. So do I assume that it is also overall market conditions that can just overnight cause big losses, especially in popular stocks, especially around earnings? And I think, the short answer to your question there, Melanie, is yes. That extrinsic value of the option is very sensitive to not only price swings, but also just the uncertainty factor around earnings. And once that uncertainty factor is gone, the extrinsic value of an option also collapses. You might have heard me on our options, on our earnings sessions where we talk about volatility crush. And where does volatility crush actually come from? It actually comes from the collapse of that extrinsic value, because the uncertainty factor is gone. So now we know roughly where the stock is trading. We know where it's likely going to expire in the next day or two. That's where the extrinsic value of an option will collapse. Even though you kind of got the directional view right, you still potentially can lose money due to that extrinsic value. So those are the two components that Jess is trying to communicate during today's session.
Mm-hmm. And you can see it easily on an option chain. Just add IV as a column, find when earnings is, and you'll see that percentage really maximized and the premium's really high relative to something without earnings.
Right, that's exactly right. Alex is someone who actually saw some of the education that you and I put together at Merrill and is welcoming you to the team.
It's nice. Thank you, Alex. Happy to be here.
Great question, Wayne, about, since the implied volatility is the unknown in extrinsic value, does the P&L simulator give us the expected P&L if we go to the options expiration? Wayne, the answer is yes. And Jess, if you can bring up the OptionsPlay platform, we can just show you the P&L simulator real quick. The one thing about the P&L simulator, and one of the things that Jess showed you during today's session, is that at expiration, there is no extrinsic value anymore. So it's fairly easy to calculate P&L at expiration because it's just intrinsic value. But yes, the P&L simulator gives you the ability to simulate what the trade will look like at expiration or prior to expiration. And anytime you're looking at prior to expiration, you can change the volatility slider. That is the implied volatility assumption. Now, we will always default that implied volatility slider to what the current market is telling us, because we always think that the markets are fairly efficient. Even if they're not perfectly efficient, they're fairly efficient. They give you a pretty good view as to what the expected future volatility is going to look like. So you can use both the P&L simulator on the OptionsPlay platform to give you a sense for what intrinsic and extrinsic value looks like prior to expiration, and also what intrinsic value looks like at expiration. So if we use Apple as an example, and let's say we use a put option, in this particular case, the May 165 puts, as you use the P&L simulator, if that expiry date is on the last date, which is at expiration, then the only thing that you're calculating here is intrinsic value, because at expiration, there's no extrinsic value. But if you move that slider to a date prior to expiration, now you have two components. You have intrinsic and extrinsic. And as you said, Wayne, the unknown part is the implied volatility. And that's why if you move that volatility slider at the bottom of your screen, you'll start to see the value of the option either increase or decrease depending on whether or not you think implied volatility will increase or decrease going forward. So, Apple's implied volatility rank right now is 51%. So it's pretty much dead center as to where the range it's been over the last year. So you could say, okay, it's dead center. I think it's going to decline because I think uncertainty is starting to ease, less geopolitical risk going forward. You think that the war in Russia is going to resolve itself soon. Maybe you think uncertainty is going to come down. You can model that and see what the value of your option is going to be, or vice versa. You think things are going to only get worse. You think more uncertainty is going to come out. So then you can add increase that implied volatility. And that will show you how the value of the option will change, which is really the extrinsic value component of that option. And Jess, feel free if you see any other questions that you think.
Yeah, I'm going through. Anonymous, that's always a fun question. How can I know if today's particular strike volume was buy to open, close, or sell to open, close? It's really difficult. There is a buyer and a seller with every transaction, so when it's traded. However, there is a lot of analytics that you can look at. If something is generally executed on the ask, then it's normally a buy, executed on the bid, a sell. So there are some analytics where you could try to figure that out. However, I don't think that would be the best way to try to figure out if there's more buyers than sellers. So there's some ways, and Tony and I have come up with some really cool stuff with volatility skew, but just looking at implied volatility purely, is there higher IV on the call side versus the put side, and that can give you some indication of weight of directional movement that the options traders feel the security is going, if that's what you're looking for. But it's really difficult to gauge that. That's a good question.
What's the time frame for completing all of these listed courses? Yes, it's once a week is the cadence at which we will be doing these education sessions. We will likely record some of these also in addition to the 1 week cadence, so that we can put together a course for everyone. But these live events will be once a week.
Mm-hmm.
This is an interesting one. Do you ever use seasonality to choose an expiration date? I will answer that question from my perspective, and I will say the answer is no. I don't know if you have a different view on that, Jessica.
No, I don't.
And Ken's asking, so in this example of Apple, what's the implied volatility of Apple? So we're looking at these May options. The implied volatility currently is around 29 a little over 29%. As you can see, the current implied volatility in the dead center is at 29.67 because that is the current implied volatility of Apple options for May. Okay, I think those are some of the questions from today's session, and we will wrap up here at this point. Once again, I am so excited to welcome Jessica to our team, and as our new director of education and product. You'll be hearing a lot from both Jessica and I with respect to teaching you how to trade options, as well as the new features that we are adding to the platform, the new platform, the mobile platform. Her and I will be working on that together in conjunction with these education sessions to help you not only understand options trading concepts, but also how to apply them using the tools that we're building here at OptionsPlay. So again, I hope everyone sends Jessica a huge welcome. And Jessica, thank you so much for joining us today, and really looking forward to working with you going forward.
Yeah, thank you. Likewise. Everyone enjoy your day.
Have a good trading day.